A lot of you have asked me for an update on Realty Income stock. The stock hasn't been doing too well over the last 5 years. It's still down over 15%. It hasn't been too good. But over the last 6 months or so, this stock has been doing amazingly well. And I did a lot of dividend stock videos on YouTube in the first half of 2024. Why? Because I thought these stocks were presenting an amazing buying opportunity, especially mid-America apartment community. I talked about it a lot. It's up 26%, ADC is up 30%. Some stocks didn't work out, but a lot of the dividend stocks we talked about have been doing amazingly well. And now I've been getting more views on YouTube and I get a little bit more haters, and they've been saying that I pretty much promote stocks to get clicks, which is extremely stupid. Because if I was doing that, I would have been doing videos on Palantir and on Tesla and Nvidia, because that's what get clicks on YouTube. But the main reason I was saying the dividend stocks is because I thought they were presenting an amazing buying opportunity. And a lot of you guys bought them and did good on them. Not because I was trying to get views or anything, but it's pretty funny. But I'm going to do an update on Realty Income and let you know my opinion and if I believe there's maybe better alternatives in the market. But a lot of you are familiar with the companies. They've been around forever. They pay monthly dividends. They've been paying it for decades. It's a pretty good company, high quality dividend growth company, you could say, REIT. And I have many different tenants. And one of the biggest ones, unfortunately, is Dollar Generals and Walgreens and Dollar Tree and Family Dollar. And a lot of you know what's been happening to the dollar stores, like especially Dollar General. It's down over 50%, and the company is struggling financially. And I got some questions on Twitter, which is a very smart question. And it says, why do you think Dollar General is going down, but the REITs like Realty Income, they are exposed to Dollar General, aren't actually coming down? This is a pretty amazing question. And I personally believe the reason for that is Dollar General isn't even closing stores. They're actually trying to open new stores. I know it sounds insane. The stock is going down, yes, because the company is having some short-term troubles. They cannot buy back stock, a lot of different things. But the company is still opening new stores. They have 2,435 real estate projects, including 730 new store openings. So it's not like just Realty Income is going to be abandoned with that stuff. I wish they didn't have exposure to Dollar General and Walgreens because I don't like them very much. As business models, I would have much preferred, the casino exposure like Wynn Resorts, which they got. And they recently did the Bellagio, MGM Resorts kind of investment. I like Walmart, Sam's Club, BJ's, and a lot of those things. LA Fitness is pretty good. Not a big fan of Dollar General, but still, I don't believe the company is going to be too affected because they're not actually closing more stores. They're actually building more stores and remodeling them. And I'm sure Realty Income can potentially lease them to a different tenant in the future. And they've been diversifying away from those tenants. And it's been improving. It's going to take some time, but it's pretty good in general. The company has surprised me a little bit because it's a pretty big REIT in terms of market cap. And normally such bigger REITs, they struggle with growing adjusted funds from operations per share, which is a metric that matters with a lot of REITs. But Realty Income has been finding a lot of opportunities in Europe, over 8.5 trillion in terms of TAM, total addressable market in Europe. They've been buying a lot of stuff at a discount in the UK. They have a lot of stuff over there, a lot of problems, and some places in Europe too. And they've been doing amazingly well, high return on capital and investments in terms of that stuff in Europe and in the UK. And it's been doing very well. Last guidance wasn't too bad at all. They did revise net income per share lower. But what really matters with REITs is AFFO per share, adjusted funds from operations per share. And they pretty much kept it the same. They kept occupancy the same. And that's what really matters to me with a lot of the REITs. That's what the metrics that I use. The company does have a lot of debt, and some of it is maturing over the next 2 years. Now, interest rates started to come down, and they could potentially refinance it. They have a good credit rating, A-. I'm sure they could do something about it, maybe at a little bit of a higher interest rates, unfortunately, but it's not like the company is going to cut the dividend or it's going to zero or anything like that because they have long-term contracts. I believe 13 years is the weighted average lease term. And I don't believe that that's going to be a huge problem for Realty Income in the short term. Now, a big misunderstanding amongst investors with REITs is they look at shares outstanding and they say, oh my God, look at the shares outstanding. Look at the massive dilution from 255 to 693. This is massive, massive dilution, massive shares outstanding expansion. It's very, very bad. And I do agree with you. It's really, really bad. But that's not how you assess REITs, because REITs do issue shares and they use some debt and they try to acquire more value per share than they issued. So what you have to look at, you have to look at adjusted funds from operations per share, not the total figure, on a per share metric. And if it's increasing over time, it means that the company is creating more value than it's taking or than it's issuing, which means the company is doing something right. I wish they didn't have as much dilution, and I like companies buying back stock, but that's why I talked about mid-America apartment communities before, because they weren't actually issuing stocks. They have the apartment, all their shares were pretty much flat, and they were just using debt and mortgaging stuff and using funds from operations to grow. And that's why I prefer this company. And I think it's still a good opportunity. But that's how Realty Income and most REITs does it. And you have to look at per share metrics with these stocks. If you look at the return potential of Realty Income, they have a good model of calculating the return, and it's pretty much what I use, which is a dividend yield. And then you add in whatever you believe they can grow in terms of AFFO per share every single year. And if we look at the dividend right now, it's at 5%. When I talked about it, it was like 6.2, 6.3%. That's when I started buying the stock. It was like 6.2 or 6.1. Now it's at 5.1% because the stock has appreciated, decently, and it's offering 5% a year. So you're getting 5% in dividends, AFFO per share on average. It was 3 to 4%. I expect it to continue. So if you're getting 4% on average AFFO per share growth every single year, you're getting a 5% dividend. This is around a 9% annual return on Realty Income from the combination of the AFFO per share and the dividend. But this is not the best part. The best part is that the company is still trading at a massive discount to its mean AFFO per share multiple. Because of higher interest rates, it became less appealing, but now interest rates are expected to come down. The stock is rallying. Jerome Powell said the neutral rate is 2 to 2.5%. The company is still trading at 14 times of a mean AFFO. Of the last one, the mean was 17.6 times. It traded as high as 24 times, and now sitting at 14 times. So I'm not saying Realty Income is going to go back up to 24 times when we had 0% interest rates or 1%. But if interest rates eventually go to 2, 2.5, I could easily see the stock trading at 17, 18 time multiple of adjusted funds from operations per share. So over the 9% returns, that would be maybe 11, 12% return, on something like Realty Income. It's not the best risk reward in the market, but for dividend investors, I still believe the stock could be a buy. The dividend is, say, 5%, and you're getting a multiple expansion, and you're getting some growth. The dividend is growing. And between VC and Realty Income, I still believe Realty Income has more upside because of more of a multiple expansion. But I did do a video on 2 dividend stocks very recently. I talked about CME Group and Verizon. You could check out CME. I think you're going to like it very much. And it's offering much more upside than Realty Income, but I have nothing against it. I like it. Everything's been going well, and I like the stock very much. It wasn't financial advice, just my opinion on Realty Income. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.